Thank you for joining me. It is Tuesday, June the 6th, 2017. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term confidence and sentiment. This month I'd like to cover some thoughts I have on the markets and how the Federal Reserve's current policy of rate tightening squares with what the global credit and U.S. business cycles are telling us. Therefore, I'd like to take us through the following areas. Last year, in our monthly Matter report, we discussed the number of Cassandras that were warning about a market correction. Throughout 2016, we tracked the increasing number, and then last year, with the list becoming so long, we simply highlighted the fact that George Soros has come out of retirement, or had come out of retirement, because of the shorting opportunities he saw, and Carl Icahn, in an unprecedented fashion, was claiming to be 150% short the equity markets. So who could be left now to warn about a market correction? Who is left? I have found the list of latecomers to be very interesting, and there are a lot of latecomers. I chose the following 5 who have recently thrown in the towel, and they're across the world for various reasons I thought were worth exploring. The first is Philip Parker, Chairman and CIO of Altair Asset Management in Sydney, Australia. And he is completely liquidating his fund. He is not the only fund that I've noticed being liquidated recently. He in fact claims he has never been more certain of anything in his life, and he cites in his example in Australia the thing that's troubling him most is an impending property calamity. He feels responsible to return money to his investors, as he says, giving up management and performance fees and handing back cash from investments managed by us is a seminal decision. However, preserving client assets is what all fund managers should, is to put their clients' interests before their own interests. The second one I saw was Seth Klarman, CEO and portfolio manager at Baupost Group here in Boston. He believes that we are all underestimating risk and insufficient margin of safety within the market. Klarman believes that the U.S. investors are greatly underestimating the amount of risk in the market right now. And to quote him, when share prices are low, as they were in the fall of 2008 into early 2009, actual risk is usually quite muted, while the perception of risk is very high. By contrast, when security prices are high, as they are today, the perception of risk is muted, but the risk to investors are quite elevated. He's not the only one screaming about the risk versus the complacency. Bill Blaine, a strategist with Mint Partners in London, UK, is talking about a massive consumer sentiment shift he sees coming. He thinks it'll happen sometime around October the 12th. His gut feel is there are just too many contradictory currents out there. The unsustainability of burgeoning consumer debt, unfeasible tight credit spreads, worries about what follows Brazil and the emerging market, the risks of massive consumer sentiment altogether because of these would create a big dump. Somebody I always find very, very interesting and has been quite negative for a long time, David Stockman. He has actually thrown in the towel earlier, but now he's out with words such as the market is exhibiting insane valuations. And remember, David Stockman is the former OMB director under President Ronald Reagan and a former U.S. congressman. He's somebody that truly does understand the markets from not only that role, but also being in finance most of his life. And he goes on to cite exactly the degree of the valuations, and he's been writing about this extensively on his own website, which he brought into existence here a couple of years ago. He thinks the market could easily drop to 16 or 1300 on the S&P. It could drop by 40% and even more once the fantasy ends, he says. Another well-known, well-established market leader, Paul Singer, founder and CEO of the Elliott Management Corporation, very large fund. And he believes the issue that will be the big one is a failed pro-growth Trump agenda and a coming looming U.S. recession. And as such, he's unloaded $5 billion worth of stock, which is 15% of fund that's under management right now. What he says is that it's a good time to build a significant amount of dry powder because of what he sees with a failed Trump policy. And he says that all hell will break loose when that realization comes in. Another well-followed person is David Kanzler. He's managing member of the Golden Returns Capital, and he feels very, very strongly and have thrown in the towel recently. And he looks at things such as Bitcoin and Tesla as signs of a late-stage market top. And he goes through in quite a bit of detail why the stock market bubble is getting ready to pop, and citing these as clear, unequivocal examples of the problems. Asher Edelman, who's a legendary investor, has only one question, and that is when, not if. And to quote him, I don't want to be in the market because I don't know when the plug is going to be pulled. He just believes it's without question going to be pulled. I'm sure there's a few out there that still haven't thrown in the towel, but they're getting harder and harder to find. We at MATA have been concerned about, as you know, a number of issues for quite a length of time, and we've expressed those in our previous reports, and they range from slowing corporate buybacks and dividends, we talked about that last month, planned central bank tightening and the risk of higher yields, the China's credit bubble, collapse of the global reflation trade, stretch PE multiples, fundamentals across all metrics, the level of global over-leverage, liquidity specific to the advancement of ETF usage in the market, and bonds, that is, amount of government bonds now controlled and owned by the central banks, and the turn in the credit and business cycles. In actual fact, I want to talk more about the credit and business cycle change because I see it having accelerated since I last really broached this subject. No central bank has ever been able to stop the natural progression and cyclical nature of the business and credit cycles. They are simply too large for central banks to overpower. With massive intervention as we've been witnessing since the 2008 financial crisis, they can affect timing temporarily. But for how long? We are now approaching 10 years since the last reversal, which is highly unusual. But then so are the trillions and trillions of dollars that have been brought into liquidity in the markets. As you know, the ECB, the Bank of Japan, and the Federal Reserve all now have central bank balance sheets of $4.5 trillion. That doesn't include all the rest of the central banks, Bank of England and China. So we're talking many, many trillions of dollars here to basically just get a minor recovery. And what's going to happen when we stop, or it's perceived that we'll stop that printing. I clearly don't believe, as you'll see, that that's going to happen anytime soon. The EU reflects a similar cycle, which historically has not been the norm, but as the world has become more financially globalized, the synchronization has become more pronounced. This is a concern as a downturn becomes global now versus historically being supported by regions doing well while others experience problems. They are all exhibiting the same cyclical nature here with the same periodic cycle. Globally, we see the global credit impulse plummet. And in fact, credit is now contracting, as you see here, versus simply slowing. We've been reporting this here for a couple months now. But we're also seeing that commercial industrial loans overall, we see here the 6-month credit flows from the 3 main global economic regions, the EU, the US, have went negative, while China is closely following here. Typically, when all 3 went negative, it has been marked by a major financial crisis of some sort. This may once again be the case, and as usual, will be something evident to everyone, but few are any longer paying attention to. Since this current bubble, if we can label it as such, is a product of the central bank liquidity injections, it stands to reason that it will be triggered and about primarily something to do with a policy change in this regard, that is, like quantitative tightening. The proof that it has been a failure For example, there's no shortage of that if you care to examine it, or possibly a region like China suddenly experiencing a 1929 like stock market crash that the Chinese government is just simply ineffective in containing. In the U.S., year-over-year loan and leases, as well as commercial and industrial loan creation has crashed. In the case of commercial and industrial loans, it's now at a 6-year low. In absolute terms versus rate of change, we see that the commercial and industrial loans have plateaued in growth and appear to be about to start contracting, which the previous charts were suggesting was imminent. You can see how closely this shift in loan creation tracks previous U.S. recessions. It is about as clear an indicator as you can get in economics, but of course we are told it'll be different this time. Here we see how closely loans and leases in bank deposits follow real gross domestic product. I don't care what the media is taunting. We're headed towards a U.S. recession sometime in late 2017 or 2018. With extensive and massive credit and liquidity creation, there is a possibility it could be delayed even further. But short of that, it's almost a lock at this point. Let's look at corporate leverage, and I've talked about that briefly before. In parallel, we're seeing that corporations are reducing their rate of lending as releveraging is turning. Again, this is a clear and indisputable signal, especially as we approach possible contraction versus just simply slowing. Commercial MFI bank credit, loans and leases in bank credit, whether for 3 months, 6 months, or year over year, are all approaching contraction, at least in the U.S. Going back to the global level, we see clearly that foreign exchange reserves are now contracting almost universally throughout the emerging and developing economies. We also see that global capital inflows, according to recent IMF reports, is steadily falling for almost all the emerging and developing economies. With all of this occurring, we are expected to believe the Federal Reserve narrative that they're going to actually tighten. Yes, we have seen 0.25% increases in the Fed funds rate from a nearly zero rate level. Yes, we are likely to see another 1 or 2 more rate hikes. But the yield curve has been steadily flattening, and therefore there has been a rather negligible sustainable impact. The real tightening expected from the Fed is from a reduction in the size of its $4.5 trillion balance sheet. The Fed is signaling that it will reduce its balance sheet by simply not replacing expiring U.S. Treasuries and mortgage-backed securities as and when they expire. The U.S. Treasury, by rolling over these bonds and the Fed not buying them, normally means that supply increases, thereby reducing price and increasing the required yield. I am skeptical of this occurring in that with approximately $10 trillion in negative interest rate bonds out there, that the U.S. Treasury supply, even with minor positive real rates, will be quickly gobbled up. As you can see from this chart, there are nearly $1 trillion, $900 billion to be precise, of Federal Reserve held bond assets about to expire in the near term. My friend Richard Duncan at Macro Watch suggests the current expectations are for approximately $400 billion in bonds to not be rolled over per year through 2021 and will in fact result in an effective Fed tightening. He believes, however, this scenario will not come to pass, even though he lays it out here. He believes and feels quite strongly that the impact of global liquidity will be devastating and will push the U.S. and global economies into a potential depression if in fact this occurs. Somewhere between his views and the scramble by NERP sovereign bonds lies the answer. No matter which, it suggests that tightening at this stage of the credit cycle makes no sense. Effectively, it is propaganda to keep assets prices temporarily levitated. The Bank of America Merrill Lynch, in fact, accepting what the Fed is suggesting it's going to do, are laying out the fact that it probably will result, if they do this, in a 30% correction, with first the Fed and then the ECB and the Bank of Japan all expected to start reducing their balance sheets over the next 2 years. A bevy of central bankers have been busy on the job-owning circuit explaining why this would not have a major impact on either bonds or stocks. They may be quite wrong, however, according to the latest analysis released by the Bank of America rate strategist Sham Rajan, who calls the upcoming trillion-dollar mismatch between Treasury supply and demand over the next 5 years a smoking gun, which will trigger an equity rate disconnect due to the gradual phasing out of price-insensitive buyers, and calculates that either rates need a 120 basis point higher move or stocks need to be 30% lower to trigger enough demand to match the forward U.S. Treasury supply estimates. Needless to say, both outcomes are negative for current record low volatility and will have a substantial impact on risk assets prices over the coming years, a vastly different forecast than the one the Fed has been scrambling to convey. Just about everybody is very, very skeptical that in fact this is going to occur. We need to remember that the ECB has announced plans to reduce its buying. Though the Fed is not buying anymore, the ECB has been running at about $80 billion a month. This will add further global tightening. I have been very concerned for some time now with the central banks, which now own 1/3 of the entire $54 trillion of global debt, which is not available for trading, obviously, that we could have a very serious liquidity problem if something disruptive were to impact the bond market. This is a tinderbox awaiting somebody with a match. I've been a long-time user of LONGWave analysis. I've found it excellent when price and time counts and form in regards to pattern are combined properly. LONGWave is fundamentally about identifying shifting sentiment cycle patterns, which takes very specific forms, shapes, often. LONGWave is least accurate when determining solely price and time form relationships, and most accurate when price, time, and form are identified specifically within fractal structures. We have generally accepted long-term LONGWave counts currently in play going back to early 80s when yield rates began their secular market. We have plotted over it the regression for this period with 2.5 standard deviation bands. I'll refer you to the MATA SII site for detailed LONGWave counts within the MATA pivot section, but I want to focus here on something slightly different within that context. The extremes associated with the 2000 dot-com bubble, the 2008 financial crisis, and the current monetary bubble, if we can call it that, show clearly at the 2.5 sigma levels. I have found that LONGWave patterns often changes at these extremes. I would like us to focus on the unique regression channels associated with each of these existing legs. Let's overlay the last leg beginning at D and here identified by the small red arrow. As such, we have moved to a weekly channel for this period of time. We can see that though the regression channel is rising, we have no extremes to the upside 2.5 sigma level, but we do have a number to the downside. Something at each instance supported the market as it went down. As we have shown throughout this leg, it has actually been about the Federal Reserve's quantitative easing through quantitative 3, Operation Twist, and the ECB, BOJ, and the Bank of England policies. And I won't revisit all of those individual events. Let's look at the next leg, which started at the red arrow when the ECB, Bank of Japan, and Bank of England combined to start pumping $200 billion per month of global liquidity. We'll use a daily chart for this leg. We can see that again we have primarily hits to the 2.5 lower sigma level going into the US presidential election. This was reversed with the Trump presidential election intervention. Since then, though we have had higher highs, we have yet to touch the upper 2.5 regression again in these smaller channels. Let's look at the regression for the next leg starting at the white arrow. Here we move to a 4-hour frequency chart. We again see a break of the lower 2.5 sigma level in May before something once again lifted the market, but not to the upper 2.5 sigma band. This pattern is telling us when the central bank's financial market stability groups are being forced to take action. This action takes multiple forms, from movement in the USD yen cross, buying of FANG stocks by central banks like the Central Bank of Switzerland, to euro-dollar swaps. It is my opinion this is the purview of Federal Reserve co-chair Stanley Fischer. When we look at the current leg on an hourly chart with our regression channel overlay, we see the likelihood of one final lift before our initial long-term regression becomes somewhat of a sentiment showstopper. Normally, something dramatic alters public sentiment through a change in perception, often the realization of a mistaken belief that is proved to be false. From the tulip bubble to the 2008 housing bubble, it has been about the realization of some accepted belief being fundamentally flawed. Look for this going forward. Remember what Benjamin Graham and Warren Buffett have taught us. Considering the price to sales ratio for the medium stock in the S&P 500 is higher than ever before, and to a significant degree you might say investors are taking the greatest amount of risk for the least amount of potential return in history. In other words, if there was ever an example of reward-free risk, this is it. And as I said previously, something always unexpectedly breaks, and it looks like we should be due for this for multiple reasons sometime in the foreseeable future. As I often do, I like to remind you, remember, they'll print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically as long as you think through the strategy clearly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 be an outstanding investment for you and your family. Thank you for listening.